Thank you for joining us for HCL Tech's Q4 and FY26 press conference. Before we get into the financials, I want to take a moment to reflect on an important milestone for all of us at HCL. This year marks 50 years of HCL Group, 5 decades of building, reinventing, leading, and giving back. And while this is a milestone we are very proud of, it's also a starting point. The next 50 years begins now. It is so very fitting that as we mark this milestone, HCL Tech has been named to Fortune's World's Most Admired Companies 2026 list. Coming to the business performance, as all of you know, FY26 began against a backdrop of uncertainty. Tariff-related volatility persisted. Discretionary spending softened in the traditional segments while emerging in new areas. And client behavior reflected a continuous focus on cost optimization, along with accelerated adoption of AI-driven productivity. Importantly, the momentum around AI remained strong, with nearly every deal incorporating AI or Gen AI component. Our ambition is to be the best AI solutions company, leveraging our engineering pedigree. Against this backdrop, FY26 marks the third consecutive year in which HCL Tech will be delivering industry-leading organic growth among all the scale players. I extend my sincere appreciation to all HCL Techies for their continued dedication and outstanding performance. In FY26, we delivered consolidated revenue of $14.7 billion, representing 3.9% growth in constant currency. And all the growth rates hereon referred will be in constant currency. The performance was supported by increasing contribution from an advanced AI and broader AI offerings. Our advanced AI annualized revenue reached $620 million. Our operating margin for the year was 17.2%, and excluding restructuring costs, margin stood at 17.9%, which is a decline of 40 basis points from the previous year. In FY26, our services business grew 4.8%, led by steady momentum in both our IT and business services, which grew 3.7%, while our engineering and R&D delivered a strong 9.8% increase. In HCL Software, revenue stood at $1.4 billion, ARR of $1.05 billion, reflecting a decline of 4.1% year-on-year and 0.5% year-on-year on the ARR. Coming to our Q4 performance, our revenue for the quarter was at $3.7 billion, a decline of 3.3% quarter-on-quarter, and a growth of 2.4% year-on-year. Our services business declined 0.1% sequentially, but grew 4.2% year-on-year. HCL Software declined 28.1% sequentially and 14.1% on a year-on-year basis. Our operating margin for the quarter came in at 16.5% or 17.7% excluding restructuring. Apart from the sequential decline due to the seasonality in the software business, we saw a delay in procurement decisions in the month of March that resulted in revenue coming below our expectations. At the same time, our advanced AI revenue reached $155 million, reflecting a 6.1% sequential increase. Our services performance this quarter came in at the lower end of our expectations. This was primarily driven due to reduction in discretionary spending on telecom, as well as discontinuation of 2 SAP programs, which happened late in the quarter. While annuity programs in telecom held steady, we saw select clients scale back discretionary investments across both digital business and engineering services during the quarter. Some of this impact is likely to carry into the next quarter, and we have factored that into the guidance that we will be providing. After 2 quarters of strong new bookings, our new deals booking for the quarter moderated to $1.93 billion. Booking momentum for the fiscal was good. TCV of net new booking for the year clocked $9.3 billion, which is the same as last year. If you look at our client categories, we've grown them across the board, starting with an increase of 1 for greater than $100 million clients, 8 for greater than $50 million clients, and all the way at $1 million range, we added 28 clients. This is a great proof of our AI strategy and our client relevance in the AI era. Our advanced AI, we did some very good wins. A global technology major selected HCL Tech for an AI factory program worth over $100 million. Our solution will fast-track the requirements of building and operating next-generation AI data centers to support cutting-edge AI workloads using the latest GPU technologies. A global semiconductor major selected HCL Tech's AI engineering services to support ASIC development across multiple advanced node chips, strengthening its position in physical AI. As we close the quarter and fiscal year, our AI strategy is translating into deeper client engagement and clear market leadership. Momentum across our advanced AI offerings and overall AI portfolio remains strong, reflecting the strength of our early bets and our continued focus on AI that scales from experimentation to measurable business impact. Our pipeline remains robust and broad-based across segments, verticals, and regions, with AI increasingly integral to nearly all deal conversations. The business environment remains highly fluid, making it difficult to form a definitive view of how the next 12 months will unfold. We are seeing second-order effect play out. Rising energy prices and supply chain disruptions are weighing on the growth outlook in Europe, with risks of inflation and industrial slowdown becoming more pronounced. At the same time, North America continues to show relative resilience with no broad-based macroeconomic challenges at this stage. While our business fundamentals remain strong, we do have 2 client-specific challenges in Americas that will create a headwind of approximately 50 basis points to growth in FY27. These clients are navigating their own business pressures in the current macro environment and have scaled back their IT and business operations spending. In our software segment, we remain focused on accelerating the shift from a perpetual model to a more predictable subscription-led model. On the margin front, the underlying margins of our portfolio remains resilient, as reflected in our EBIT margins excluding restructuring. As we navigate specific growth challenges in FY27, we intend to reinvest the benefits of currency depreciation into strengthening our AI capabilities and our sales engine. Our guidance for financial year 27 is as follows. The revenue growth guidance for the full year is 1 to 4% in constant currency and 1.5 to 4.5% for services. EBIT margin guidance is at 17.5 to 18.5%. Now I will request Shiv to walk you through more details on our financial performance. Thank you.
Thank you, CVK. Good evening, everyone. Thank you for joining our Q4 financial year 26 earnings call. Let me walk you through our financial performance for the quarter first. Total revenue for the quarter is rupees 33,981 crore, which is a growth of 0.3% quarter on quarter and 12.3% on a year-on-year basis. Coming to the services side, services revenue came in at rupees 31,230 crores, which is a growth of 3.5% quarter on quarter and 14.2% on a year-on-year basis. The software revenue for the quarter came in at rupees 2,857 crores, which is a drop of 24.6% quarter on quarter and 5% on a year-on-year basis. Moving on to profitability for the quarter, our EBIT came in at rupees 5,620 crores at 16.5% of revenue. On the back of seasonally strong O&D quarter for HCL Software, our EBIT dropped by 10.6% quarter on quarter and grew 3.3% on a year-on-year basis. Net income for the quarter is at rupees 4,488 crores at 13.2% of revenue. Now moving on to our financial performance for the financial year 2026. Starting with the revenue performance. Total revenue for the year is at rupees 1,30,144 crores, which is a growth of 11.2% on a year-on-year basis. Coming to the services side, services revenue came in at rupees 1,18,158 crores, which is a growth of 12.1% on a year-on-year basis. Software revenue for the year came in at rupees 12,397 crores, which is a growth of 2.9% on a year-on-year basis. Moving on to the profitability, our EBIT came in at rupees 22,397 crores at 17.2% of revenue, down 107 basis points year-on-year. Our EBIT grew 4.6% on a year-on-year basis. Net income for the year is rupees 17,361 crores at 13.3% of revenue. EBIT and net income exclude the one-time impact of new labor codes. Including the same, FY26 EBIT is at rupees 21,441 crores and net income is rupees 16,642 crores. Moving on to return on invested capital, ROIC. Our ROIC continues to improve thanks to our ongoing focus on profitability and efficient capital management. The last 12 months ROIC is at 40.3% for the company, up 235 basis points year-on-year, and services ROIC now is at 47%, up 155 basis points year-on-year. Software continued to improve with ROIC at 22.6%, up 274 basis points year-on-year. Now let me share the details on our strong cash generation. Our cash generation remains very strong. Over the last 12 months, operating cash flow reached rupees 19,975 crores, while free cash flow generation was at rupees 18,553 crores. Our balance sheet remains strong with gross cash at rupees 33,447 crores and net cash at rupees 33,288 crores. Operating cash flow to net income conversion is healthy at 115% and free cash flow to net income conversion is at 107%. Update on DSO. Our total DSO, including unbilled, is currently at 84 days, which is an increase of 3 days over previous quarter. And now for the shareholders, the diluted EPS for last 12 months came in at rupees 64.01, which is down 0.1% year-on-year. Including the impact of new labor code, the diluted EPS is rupees INR 61.36. The board has declared an interim dividend of rupees 24 per share for the quarter. The record date is 25th of April 26 and the payment date of the same shall be 5th of May 26. That brings our last 12 months payout to rupees 60 per share, effectively distributing 97.6% of our net income for this year. That's all from my side for now, and I would like to hand over the discussion to Ram for an update on HR matters. Thank you.
Thank you, Shiv. Good evening, everybody. Am I audible? Okay. Good evening, everybody. For the quarter ending March 26, our people strength is 2,27,181, That's a sequential increase of 802. On a full year basis, our people strength increased by 3,761. That's a 1.7% increase annually. If you look at it, the revenue grew at a faster pace, implying the revenue per employee continues to accelerate. This quarter, we added 1,712 freshers. The number is very similar to what we added in the JFM quarter last fiscal. On a full year basis, we added 11,744 freshers. That's about 50% more than what we did in FY25. If you recall, at the beginning of FY26, we did say that our plan for FY26 is to significantly increase the fresher hiring, and that pretty much is what we have done through the year. IT services voluntary attrition trailing 12 months at 12.5%. On a full year basis, from FY25 to FY26, that's a 50 basis points improvement.